Hi, I'm John Pearce, Chief Investment Officer, and welcome to this investment update. Today I want to take stock of the enormous volatility that we're experiencing in 2022. I want to explain the big driver behind this volatility, and in particular, the actions of the Federal Reserve of the US Central Bank. And finally, I'd like to provide some reassurance that over the medium term at least, I think things will get back to normal. When I addressed you in July, we were wrapping up a pretty tough financial year. And at that time, I did express quite a bit of concern about the prospects for the remainder of 2022. It turns out, unfortunately, that my caution and concerns were well founded, because indeed, the markets have been very volatile. I think this graph illustrates it perfectly. Here is a graph showing the movement in the S&P 500, the US stock market, over the course of 2022. Let's put things in perspective here. The US stock market constitutes over 60% of the global indices. It's really important, and what the US stock market does, typically others follow. And we see for the first few months, some few ups and downs, but nothing really to get that concerned about. And then in April, US inflation printed at 4-decade highs, 8.5%. June, our worst fears were realised. Inflation was persistent, printing another record. Any notion that inflation was transitory was quickly extinguished. Then a strange thing happened. In July, the markets actually staged a remarkable, impressive rally. There were a few people that weren't particularly impressed. I'm referring to the US Fed officials. It all came to a head in Jackson Hole, Kansas. It's an annual symposium, and the US Fed Governor, Jerome Powell, got up and he had a few direct words to say to the participants. Paraphrasing some of his messages. Our responsibility to deliver price stability is unconditional. High rates will bring some pain to households and businesses. We will keep at it until we are confident the job is done. What Powell was basically saying is that confronted with a trade-off between higher unemployment or higher inflation, they will take higher unemployment. This set the market off into another swoon. And in September, we saw new lows created for the cycle. The old adage, do not fight the Fed, is well and truly in place. I think it's important to remind ourselves why the US Fed, why the US dollar is so important. I've already mentioned that the US market constitutes over 60% of global indices. But if we think about the US dollar, it greases the wheels of the world economy. On most cross-border transactions, at least one side sits the US dollar. So when Australia, Japan, China trade commodities, contracts are signed in US dollars. Global reserves. US dollar dominates the global reserves of central banks around the world. There's a saying, the US dollar is America's currency, but it's the world's problem. And that's exactly what we're seeing. When the US Fed is tightening rates, is actually lifting the price of US dollars. Not only is it doing that, it's actually taking US dollars away from the system, this quantitative tightening. So what we're seeing in financial markets is a rapid appreciation of the US dollar, and that is feeding into a lot of pain in stock markets and bond markets. I'll go as far as to say, despite the fact that we do have geopolitical issues, despite the fact that we have China embarking on a zero COVID policy with ongoing lockdowns, it is the tightening of US dollar liquidity by far the most important factor when it comes to what we're seeing in terms of stock market and bond market instability. Unfortunately, when markets crash, super funds are not immune, and we've seen that across the board. In calendar 2022, the only option at this point that's recording a positive return is cash. It's been the only place to hide. All growth options are currently recording negative returns, balanced option down about 9%, and international options closer to around 20% down for the 2022 calendar year. We have to bear in mind that this follows a decade of pretty good returns. We talk about international options. Well, they're still recording double-digit returns over 10 years, even though last year has been pretty terrible. So a correction was somewhat inevitable. Also inevitable is the fact that we had to somehow pay for the policies that we imposed during COVID. Let's think about this. During COVID, we had enormous supply constraints, yet at the same time, we were lining the pockets of households and corporates. So you had limited supply and excess demand. What do we get? Inflation. So to me, inflation is pretty much the financial cost that we are now incurring for COVID. The good news, of course, is that it is not going to last forever. And already we are seeing a lot of relief on the supply side of things. If you look at shipping costs, commodity prices, etc., they're all showing relief on the supply side. And there are some other positives to focus on. I've mentioned before that we're seeing excesses in the market being eliminated. If you look at the Australian housing market, there's a bubble that's being pricked. We pricked, arguably the biggest bubble in history, the crypto bubble. We're seeing the world get rid of negative interest rates. Only Japan has got negative interest rates. And this is quite profound. The implications for investing are really important. I do want to expand on this for a little while. Most importantly, we can now take less risk to achieve any desired level of return. Let me explain by way of an example. If we cast our minds back to 2000, if you wanted to get 7% return, you could construct a portfolio pretty much 70% cash, okay, and some Aussie equities, and hit that number. For this example, we're using 3 asset classes: cash, Aussie equities, corporate bonds. That's a pretty good place to be in. You can have almost a risk-free portfolio and hit 7%. Roll the clock forward to 2015. Look at the situation then. We're in financial repression. Rates are nearly zero. To achieve 7%, you had to take a lot of risk. Portfolios pretty much dominated by equities. Then in 2020, in the depths of COVID, forget about holding any cash or corporate bonds. To get 7%, you pretty much have to be 100% invested in equities. So where are we today? Well, no negative interest rates on the rise. Guess what? You can actually hold bonds now, and quite a fair bit of bonds, to hit that 7% mark. So the way I see it, things aren't feeling particularly good at the moment, but we're actually getting back to a sense of normality, and that's a really good thing. What else is positive? Well, I believe that the Fed is actually closer to the end of its tightening cycle than the start. I know there's a feeling that all the Fed officials are walking around with a proverbial hammer in their hand and every problem looks like a nail. I know that some commentators are saying that the Fed is not going to stop until they really break something. I don't subscribe to that view. Yes, the Fed does have a price stability mandate, but the Fed doesn't have a mandate to put millions of people out of work. And I'd suggest that they would start losing their political support if indeed it got to that position. My view is that we're not far from the time when the Fed will have to pause just to see the impact that the rate rises are already having as they work their way through the system. And finally, stock markets are now trading at levels that historically have proven to be pretty good entry points for long-term investors. And indeed, at UniSuper, we are deploying some of our cash to take advantage of depressed levels. We're not stating that we've seen the lows, because we'll never pick the lows. We just believe that the risk-reward equation favours taking some risk at the moment. We've still got a lot of dry powder in the event that markets fall even further. And we're seeing opportunities across the whole curve. We've got some excellent opportunities with bank debt. We're picking up over $1 billion of major bank paper, around 6.5%. And these levels were around 2.3% not that long ago. Excellent opportunities in unlisted assets and, of course, the share market generally. We haven't lost faith in the cycle. And many of you would have seen this picture before. It's the economic financial market cycle. Looks like we're about 5 minutes to midnight there. And midnight could bring about a recession. I'm personally not that concerned with the recession. If you look at the history of economic cycles, recessions are very common. But after every recession is a recovery in the economy, a recovery in the stock market. The cycle never dies. Thank you very much for tuning in.